Episode 36. 1936 was the origin of the Social Security number. Did you know you can keep an RESP open technically for 36 years? In shocking statistic, only 36% of Canadians understood the costs of their investments based on a survey by Morningstar. Beyond MD, episode 36, here we go! Hey everyone, welcome back to the Beyond MD podcast. Tomorrow, November 26th, there is the Physician Financial Wellness Conference that is hosted by the one and only Dr. Steph Zhao. Apparently, I'm the right person to be talking to medical students and residents about mortgage basics because the truth is, I have screwed up mortgages at every point in my life. It seems like I made the wrong decision every time, but I tend to be the type of person who sees the silver lining and learning opportunity associated with every situation. But the truth is, when interest rates are this high, there are no moral victories. It is just downright painful and depressing. But regardless, I will be there Saturday in the breakout room with a smile on my face, educating people to the best of my ability on mortgage basics and some basics on incorporating. So there is a link to the conference in the show notes. Feel free to check that out. So let's just get right down to the stats on mortgages. Recent Globe and Mail article, about 670,000 variable rate mortgages issued in Canada since the start of the pandemic. Now, about 50% of Canadians who have mortgages have a variable rate mortgage. That's a lot higher than usual. Up until now, about 50% of these people on variable rate mortgages have hit their trigger rate. And the Bank of Canada says that in early 2023, that number could rise to 65%. So let's just stop right there and understand what the trigger rate is. So many banks will offer a variable rate mortgage product such that every month you're paying a static payment. The amount of that payment stays the same, but how much principal and interest is paid fluctuates depending on the variable rate. Now, interest rates have gone up so high and so quickly that many people are getting calls from the bank saying that, hey, the amount of your monthly payment, it's all interest. You're not paying any more principal. So therefore, we need to raise your monthly payment. Something to look out for. Trigger rates is something that we haven't discussed in decades. And truthfully, it's not something I was even aware about. But now it's a very prevalent concept and something to be aware of. So I did make a recent investment into a small multifamily property in my hometown of Kingston. This was in September. And the reason I'm sharing this is I found quite a bit of variability when it came to mortgages. I decided to make this purchase through my holding company, and I was put in touch with a mortgage broker, and it turned out that that broker was dealing almost exclusively with a single lender. So this is a question you want to be asking your mortgage broker. How many lenders do you deal with? The first rate that I was offered was prime. And I said, no, I think I can do better than that. So I had to make a few phone calls. Then I got to prime less 0.25, and then finally to prime minus 0.6%, which is ultimately what I went with. Another area where I was seeing a lot of variability when it came to the holding company was most mortgages that were being offered did not come with a home equity line of credit. In fact, only one bank that I talked to was a maybe on the home equity line of credit. I'd be curious what others are experiencing when investing with their holding companies. Please give me a shout because, as you know, we're all in this together and we're all here to learn from one another. So for the episode today, which is an update on mortgages, we have Elan Weintraub, and it's his second time on the podcast. He was also on for episode number 4. Elan is the co-founder and director of the Mortgage Outlet, which is one of the largest independent mortgage brokerages in Canada. Elan is all over the media, and his brokerage has received numerous industry awards, including Mortgage Broker of the Year. And Elan is very proud of what he and his business partner, Sean Stillman, have accomplished, as they should be. So without further delay, here is my interview with Elan Weintraub. Okay, Elan, it's been 2 years since you were on the podcast. Really happy to have you back again. Where does the pod find you today?
I'm actually in my home office.
Elan, let's just jump right into this. I mean, since we last spoke, interest rates have shot up considerably. The prime rate, I believe, is now at 5.95%. What are you seeing right now in terms of trends in the mortgage landscape?
Well, there's a lot of stuff going on. I mean, the first thing I would say, as you said, is prime is at 5.95. Rates have gone up 3.5% in the last, call it 9 months, which is one of the fastest increases in mortgage rates in the history of time. The other thing that's kind of really impacting buyers, existing homeowners, is the contrast effect, which is in January, I had rates of like 1% variable, And today those rates are like 5.5% variable. So, and this is all within the same calendar year. So it's not, you're looking at this line chart over 5, 10, 20 years. This is all within the same, year. So clearly the big thing is, really rapidly rising rates. And again, I Googled this, and the Bank of Canada said rates will stay low for a long time. And I guess that's, a little bit subjective, but I don't necessarily think anyone was predicting this much this quickly.
I thought that I was a genius in January 2021 when I refinanced, and I told myself I'm never going to go fixed again. So I went variable, and I thought I was the smartest guy on the block. And then here we are.
Well,
I tell you what, like, I have never gotten mortgages right ever, but my mindset has always been long term, and I'm trying to keep it long term to kind of ride this out. And I think long term will all be okay, but it's just a bit of a bump in the road that we need to ride out.
That's exactly right. And it's funny because you used an expression that I use very specifically. My first mortgage was a 10-year fixed rate mortgage. And when I signed that, I was the smartest person in the room. And that was like, 15, 20 years ago, right when rates started to plummet. So I was the smartest person in the room. Now, the other thing is, and we can get into this, it's a very small topic. It's an inside joke that within mortgage brokers, that the 10-year fixed rate mortgage is generally the worst mortgage you can get. So not only did I, smartest person in the room and then rates plummeted, but I also signed up for what generally many people consider to be the worst mortgage you can get is a 10-year fixed.
All right, I feel a bit better about myself now.
But, yeah, and actually, I want to say one other important thing, which is, hindsight is 2020. And you made the correct decision at that point in time based on the information that you had. Just because rates changed and what have you, like you can walk into a casino and win. That doesn't mean you figured out how to beat the casino, right? There's certain degree of luck and circumstance, but you probably made the correct decision at that point in time with that information.
Fair enough. I mean, also influenced by the fact that to this point in my career, I have broken a fixed mortgage twice, and I was determined not to let that happen again. But here we are. But anyways, so I know you brought your crystal ball today, but I mean, to the best of your knowledge, what's your take on where interest rate hikes go from here?
So I think we're going to see another 2, maybe 3 25 point hikes in December, January, and then maybe Q1. And then I actually think that we'll see some decreases at the end of next year. Now, the analogy that I've been using for inflation is, imagine you have a forest fire and you put tons and tons of water on it and you basically extinguish it, but there's a few small embers of fire. You need to keep dumping water on that small fire, because if you don't, the whole forest could erupt again. I think that's how the Bank of Canada feels about inflation, which is we don't need it to be like under control or contained or like confident. We need to be absolutely sure that inflation is like checked and we're good, and then we can move on.
That is quite the analogy. I've never heard that one before, but given how things have been happening, I can see why they're thinking that way. So I like that one. And Elan, last time we focused a little bit more on fixed versus variable. Today, I'd like to kick things off with talking a bit more about the variable rate mortgage versus the adjustable rate mortgage, because I can tell you that when I started to differentiate between different types of mortgages, the adjustable rate mortgage is something that just wouldn't really come up as much. And today, I think it's becoming a more interesting topic because, and you could get into this with your answer, but we have the concept of trigger rates. And if you're on the variable rate, well, your cash flow is steady month to month. You're paying the same amount. You're just fluctuating between the amount of principal and interest you pay. But then my understanding is that if rates keep hiking and you really don't pay down enough principal by the time your term ends, you could be in for a little bit of a shock when you go to renew. But maybe you can address all of this and talk to us about what we need to know variable rate mortgages versus adjustable rate mortgages and the key differentiators between the two.
Yeah, sure. I mean, that's a very advanced question and something I wanted to talk about. So thank you. You know, I try to not use the buzzwords or the jargon, but the way I describe it is, and I'm going to be specific here, and I'm gonna name names because I think it's important. If I look at the big five banks or the big six banks with National Bank, Scotiabank and National Bank of Canada have what's called an adjustable rate mortgage. And what that means is for all the Scotia clients that have a mortgage tied to prime, all the National Bank clients that are tied to prime, every single time since, February, March, when rates started rising, their monthly payment is increasing. So I have clients with Scotia where their payments are, 20, 30, 40% higher approximately than earlier in the year. Now, the other four banks, so not Scotia, not National Bank, they have what's called a variable rate mortgage. And the way that those work is, let's say your monthly payment is $5,000 a month and rates were, again, let's just say 1% in January. Well, maybe 4,000 of that 5,000 went to principal and 1,000 to interest. Then rates went up. Then it was 2,500. Then rates went up. Then it was 4,000 interest, 1,000 principal. Then rates went up. Then your entire $5,000 payment went directly to interest and zero went to principal. So that's the main difference of adjustable versus variable. And again, Scotia and National Bank, your monthly payment will change every time rates rise. And with variable rates, generally they're going to change the amortization period. So that's the first part of your question. But then the second part of your question, which is another key trend, which is something that we've never really talked about in the mortgage community for years and years and years, is trigger rates and trigger points. So in that example, let's say you have a mortgage with one of the other banks and your payment is $5,000. And again, slowly, more of your payment is going to $5,000 to the interest and not the principal. Eventually, the way rates are going, you're going to get a letter from your bank to say, hey, Elan, your interest is $5,300 a month. Your payment is only $5,000 a month. Your interest is actually greater than your payment. You need to increase your monthly payment.
Wow.
And that would be like a trigger rate or a trigger point. And every bank has different policies. So it's, I don't want to get too granular on that, but it's basically your bank will contact you potentially to raise your monthly payment. And these banks are sending, hundreds of thousands of these letters every single month.
Okay, that's very interesting because to your point, this was a topic that was never discussed in the last few years. So what you're saying is that today, as things stand, people are getting letters in the mail that based on the monthly amount that they're paying, the rates have risen so high in some cases that the interest that they owe exceeds their monthly payment, and hence they have to kind of up their payment month to month. Is that what I'm hearing?
That's correct. But some lenders will actually let you negatively amortize, meaning they'll actually, again, without going through a whole thing, they will actually really keep your payment at the same amount, even if the interest is higher. But again, you really hit the nail on the head. On renewal, they're going to say, oh, guess what? There's $40,000 of principal that you never paid. Either give us the $40,000 or refinance, which is a whole new application, or this or this.
In terms of the banks that offer the adjustable rate mortgage, you mentioned National Bank and Scotiabank. So the other four big banks don't offer this at all?
Again, I want to pause on it all, but in general, the other four banks have variable rate mortgages where your monthly payments are generally the same month to month.
Now, in terms of prepayment options, and let's say somebody wanted to break the mortgage, in terms of prepayment abilities and penalties on breaking mortgages, are there any differences between the variable and adjustable rate mortgages?
There shouldn't be, no. But do you want to talk about what people should do if they have a variable rate mortgage?
Well, that was my next kind of question, or at least in today's environment, when somebody comes up to you and says, well, I don't want to go fixed. I want my mortgage rate to essentially follow the prime rate. I want to kind of take that long-term shot. What are the key considerations when you're helping somebody to decide variable versus adjustable rate? And then please tack on whatever you think is necessary.
Sure. So, I'm a big believer in the word psychographics, and people kind of understand their emotional needs and fears and what have you. So, I mean, frankly speaking, if this is communicated to the borrower, most borrowers prefer to just have a variable rate mortgage with a relatively constant payment. I deal with a lot of, high net worth clients. Like I have clients now, it's like a lawyer and a lawyer. They each make, call it 200,000 each, and they each get, let's say, a $500,000 bonus. The problem is when your payments have gone up from like 7,000 to 9,000, 10,000, your bonus, which is coming in 9 months, is not like, you can't really wrap your head around that. So the cash flow stability of the variable rate mortgage is extremely attractive. But what I would advise, and I think it's important, what I would advise to clients in a variable rate mortgage, if you can afford it, is, there's kind of 3 things you could do. Number one, let's say you're that lawyer and you get $100,000, $200,000, $300,000 bonus. You should put some of it, as much as you can, into the mortgage. You should consider changing your payment frequency from monthly to bi-weekly accelerated, or even weekly accelerated. And also even increasing your monthly payment. If it's $3,000 and you could pay $4,000, that is a good idea. Now, there's a term that I know you'll like, and it's the after-tax risk-adjusted rate of return. So what is that? It's a big fancy term, but like, let's think about that. After-tax risk-adjusted rate of return. Let's say you get a $10,000 bonus. You could put that in the stock market. You might make a 10% return. You might make a 0% return. You might lose 10%. But let's assume you get a 10% return, and then you're taxed on it at, let's say, 30%. Your real rate is 7% of profit. But if you have a mortgage and your mortgage is at 5%, that's a guaranteed 100%. When you make a prepayment, that's a 100% like risk-free, like that you're getting that return, and it's after tax. So in a lot of cases, paying down your mortgage, if you've got a rate of 5-6%, is one of the best investments you can make on a risk-adjusted after-tax rate of return.
I'm so happy you mentioned that, Elan. I mean, I like that term, but to get this practical example and to see these differences, the way you described it, I think is really, really useful. And that's something that I'm doing as well. So every single month, yes, I try to kind of keep up with my long-term investment strategy, but I also, especially in this environment, am putting some extra towards the mortgage, which will pay off the principal a bit faster.
And again, when you're, I use a lot of analogies, but when you're in these variable rate mortgages, you're kicking the can, and you're kicking it down to the 2-year, 3-year, whatever your renewal is. Now, again, the context matters. If you're, let's say you and your wife just had a baby and you're on mat leave and pat leave for a year and your income is a little lower, that might not be the time to go out and make prepayments. But if you're like, oh, my career is going well, my business is going well, that would be a time. So again, the context really matters as well.
Absolutely. The next question I do want to ask you is, what are you seeing in terms of the mortgage approval process? Like compared to 1 to 2 years ago, how much harder is it to get a mortgage? And maybe, Elan, you can kind of tailor your answer towards medical trainees, because I know that in many cases, or at least include this in your answer, they can be approved based on future income in some circumstances, but I'd like to touch on that as well.
Yeah. So, first of all, the mortgage world is definitely getting harder, and I'm gonna give you a quick example. But I had a physician, and he locked in at 1.69% about 12 months ago, and he locked in with one of the big banks, and I mean, amazing, like such a good rate. But then he wanted to sell his $2 million house and buy a $5 million house, but his current bank would only approve him for a $4 million house. So he had to break his mortgage at, under 2% fixed, pay a penalty, and then go with a different bank. So to answer your question, lending is tighter. The stress test is higher because, again, earlier in the year, we were stress testing based on a 1% rate. Now we're stress testing at around 7.5%. And lenders are tightening. They're more concerned about, property values, about ability to pay. Now, again, another famous example that I use is when you walk into your bank, if you walk into your local bank, it's like walking into a BMW dealership. They're not going to tell you that Audi is on sale. They're not going to tell you that Tesla is more fuel efficient. They're not going to tell you that a minivan is better for your carpool. So it used to be that rate was the number one thing, but now it's rate, it's adjustable versus variable. It's, am I approved for 3 million or 4 million? So these are the things that, again, as a physician, you want to pick what are the things that are important to you and understand what Jeep has, Ferrari, Tesla, minivan, Chrysler, as opposed to walking into BMW and walking out uninformed.
Now, what about medical trainees? Let's
Yeah.
say I'm a resident and I have a current income of $65,000 a year, but 2 years from now, I'm set to make about $400,000 a year. What does that mean in terms of my mortgage approval?
Yeah, a great question. I actually do a lot of work with residents. And again, this goes back to my whole BMW versus Ferrari, Tesla, Kia example. Let's say one bank will say, oh, you're a cardiologist, we're going to prorate your income at 300,000. But another lender will say, you're a cardiologist or going to be a cardiologist, we're going to prorate your income at 400,000. And another lender might say 200,000. So even within each specialty, that's one lens that we use. The other lens is, sometimes you might take a year off and travel or do different things. It really might boil down to one lender will look at 12 months since you complete it versus another lender will consider you new, 24, maybe even 36 months after you complete it. And if you can imagine, again, I'll just use that example. If you're a cardiologist and you're building up a practice, well, your income in the first year or two might be lower. But then if you kind of walk past that threshold where you're no longer considered new, you might be in that zone where I'm not a new cardiologist and I don't get the 400, but I have 2 years of tax returns and my tax returns show 150. So it's something to keep in mind for newer residents and new physicians, definitely.
What I'm extracting from your answer there is that there is variability in terms of the bank's kind of the timeline to when you're earning that income potential, and then also what specialty you're going to be practicing. All of those things essentially get factored into what you could be approved for. Is that safe to say?
Definitely, that's correct.
I closed on one property recently, closing on another one, and that's kind of it for me for the time being in terms of real estate investments. But one trend that I'm noticing is I had an appraisal done in May. And at that time, things were still being appraised a little bit higher than what we paid for. And now in the fall, the appraisals are essentially coming out to the purchase price. But I'm wondering what you're seeing in terms of appraisals and refinancing. And in fact, are things even coming in below purchase price? What are you seeing right now?
Yeah, so there was a massive shift in Q1, Q2, or I should say more Q2, when the market shifted. And I'm going to give you kind of a really horror story. Knock on wood, it didn't happen to many people that I know. But let's say you bought a property in March and you bid $600,000 over the asking price, and you gave your file to your bank or whatever, your mortgage broker, and they never really bothered to get the appraisal done because the closing was in August and they'll get it done and whatever. And all of a sudden they ordered the appraisal in July and you paid X for it. And now in July, the appraisal that came out in July is going to be $400,000 light because you appraised it in July when realistically you should have been appraising it within a week or two at the most of when you bought the property. Now, the other half of that story is not only did you buy your home in a bidding war, you were going to sell and you were going to paint your house and you were delayed and you ended up listing it 2 months later. Well, now you're buying and selling in a completely different market. And now not only did you buy at the top, but when you sell, you're going to get $400,000 less than if you would have sold in March. So literally you're $800,000 light, which is a big problem. Now, to answer your question today, we've gone through all that mess. It's appraisals in general are coming in on value. The exception to that is, and I just had this, someone bought a $2.4 million house in Richmond Hill pre-construction a year ago for 2.5 billion, and it came in at 2.2 million today. So they've been building it the last year and now it's ready to build. and it came in at 2.2 million, and the client has to come up with the difference.
Clients having to come up with a difference. Is it safe to say that today this is happening more often than February, March? I would assume so.
So I don't think it's happening more. I don't think in February, March, everything was pretty good because appraisers saw that things were going crazy and they accounted for it. And then if you bought a house last week, you're not going to pay $400,000 in general over the asking price, or if you are, it's on a much lower basis. It's really the people that kind of bought in March and appraised in, June, July, August, they were the ones that kind of got hurt. But if you're buying a house today, the market is now stable. It was that transition that was really the problem.
So I think I had my everything a little bit reversed. So in fact, it was earlier in the year when people may have bought really high, the appraisal came in maybe a bit lower and they had to cover the difference.
Yep.
Okay, fair enough. So I want to move on to holding companies because often what happens is in medicine, you practice a little bit, you create a medicine professional corporation, and then on the side, some of us will go on to create a holding company, and then some of us will pursue real estate investments through that holding company. And it's a path that many of us take. I recently had conversations about this, and then I found that there was quite a bit of variability or even unexpected information investing in real estate through a holdco when it came to three things. So the rates were often not as favorable as compared to personal rates. I often found that there was a ton of variability in terms of will a bank be willing to set you up with a HELOC, and we can talk more in detail about that. And then also major challenges if trying to pursue a joint venture through a holdco, let's say with a investing partner who may not be incorporated. I just found it to be such a maze. Can you talk about these things? Can you talk about some of the challenges when investing in real estate through a holding company?
Sure. On a simple level, I think the scale is really the factor here, the scale and the complexity. So let's say, you're a physician and you've built up some wealth and you want to buy a property, and your accountant and lawyer suggest you buy a property in a holding company. In general, the holding company would be the owner of the property. The physician would personally guarantee that mortgage, and it would probably show up on their credit report as a personal liability, because at the end of the day, if that holding company defaults, the lender is going to come after the person. So there's a lot of misconceptions there, but to be very specific, the rates on a holding company, they're, I would say they're anywhere from depending on the situation, 15 to 40 basis points higher on a very simple level. But that would be a very kind of simple, wholesome holding company. Now, once you start getting more advanced, and when I say advanced, maybe you have 7 properties, maybe you've got a joint venture, it starts to become this analogy where you're trying to squeeze too much down the pipe, and you're starting to be more of a commercial real estate investor. The way that I would articulate it is the lenders are sort of implicitly asking, are you a physician or are you a commercial real estate investor? Because once you have I can see you're smiling because I think that's a really important lens. It's like, I've got a joint venture and I don't want to be personally accountable, and I don't want this and I don't want that. You're starting to be a commercial entity as opposed to a person with some more advanced tax and legal liability structure.
One thing that I did come across is only one bank. Now, I didn't talk to every bank, but only one bank was willing to consider a HELOC attached to the mortgage if investing through a holding company. Is that your experience as well? And maybe, Elan, you can take just a second here to just educate listeners about the HELOC, because I do think it's an important topic.
Sure. So, so what is a HELOC? A HELOC is an acronym. It stands for a home equity line of credit. It operates like any other line of credit, except that it's directly tied to your mortgage, and there is collateral and security against the house. You need to qualify for it. And you get a slightly lower rate because it's tied to the house. But I will say this, and I don't want to forget this, physicians, they can get an unsecured line of credit at very, very competitive rates because the banks like the physicians, and then it's not tied to the house and there is no collateral. So as a matter of fact, one of my close friends works for a big bank, and it drives him crazy that, he works in credit risk, that a physician might get, a $200,000, $300,000, $400,000 unsecured line of credit at a rate under prime, which most people, that might be a secured line of credit. So that might be an avenue I would explore as a physician for sure as well. An unsecured line of credit, by the way.
And then so if somebody does have a HELOC attached to their mortgage, typically the rate on that HELOC will be somewhere around prime, but it's going to fluctuate with the prime rate, right?
Yeah, it's generally a variable rate. It's generally prime. Again, generally it's interest only. So it's really nice from a cash flow point of view because you're only paying off the interest. Now, the advantage and disadvantage of that is if you're disciplined, it gives you a lot of flexibility. If you're not disciplined, literally 30 years can go by and you'll owe the same exact amount of money because you keep borrowing more money. But it is a very useful tool if you own a property and let's say, there's a flood in the basement and you need $50,000 quickly, you can just pull it out and then deploy that $50,000 to renovate the basement. So it is a very useful tool.
Now, I have come across maybe some slight variations on the HELOC. I've heard people talk about maybe packages where if you're paying down principal, every added value of principal, you might be able to add close to $1 into the HELOC as well. Like, are there variations of the HELOC that exist like this?
Well, there are variations, and that's one where it's every lender has a different name for it, but it's kind of like an all-in-one mortgage and HELOC. So let's just say I borrow $1 million and then I make $1,000 payment, and let's just say $500 of that $1,000 was principal. Well, then I would have a $500 available credit in my HELOC where I could pull it out. So in your first month, generally speaking, there's not going to be a lot of equity that you could pull out. But over time, a year, 2 years, 3 years, especially when rates were 1%, you'd actually have a lot of principal pay down and then you could pull it out. But I'm going to say this, and this is important. Mm-hmm. The regulator hates this product. The main regulator of the bank is called OSFI, and they hate this product. And the reason they hate it is you could theoretically indefinitely keep borrowing all your money back. And that puts the bank at risk, et cetera, et cetera. So they've outlined changes to the exact product that you mentioned, and they're tightening up how much you could borrow and the ratios and that dollar for dollar thing. And that's coming pretty soon.
Okay, the current ratio of how much you can borrow in your HELOC, is it still up to 65% of the kind of fair market value of the home? What you purchased it for?
As long as you income qualify, you could borrow 65%. And then if you want to borrow more money, you would take that remaining 15% as a traditional either fixed rate mortgage or variable adjustable rate mortgage so that you could pull out the entire 80%.
Because we have a few minutes, maybe I'll give you a chance to just kind of plant the seed for commercial mortgages, if you'd like to, because I do know many physicians out there who are interested in expanding their real estate portfolios. Mm-hmm. And so that may mean, investing in a new clinic. In fact, one of my closest friends is opening up a clinic out in BC. And I know other physicians who want to invest in multifamily properties where there are 5 or more units. So what are kind of some very basic considerations for commercial mortgages? What do we need to keep in mind?
Yeah, you know what? Commercial mortgages are very complicated, but they're very simple. Why are they very simple? Commercial mortgages are almost extensively based on the cash flow that the property is yielding relative to the operating costs and interest rates and monthly payments. So going back to what we were talking about earlier, let's say you bought a property in Toronto in a holding company. Now, Toronto has never been a city that cash flows. What I mean by that is your rent is $3,000, but your mortgage payment, property taxes, maintenance, all that stuff, insurance is $4,000. So you're basically losing $1,000 a month in Toronto. That's been the sort of mantra of Toronto for many, many years. But you buy a place for $1 million, in 5 years, it's worth $2 million. So Toronto has always been about the capital gains. Commercial real estate does not work that way. Commercial real estate is how much cash are you generating? What are your costs? And we will lend accordingly. And they don't necessarily care that you're a physician making tons of money if the property is losing and losing and losing tons of money. The other thing with commercial is asset class. So is it a gas station? Is it a threeplex, a triplex? Is it, multifamily? Is it, raw land? And again, that's gonna kind of impact it. But generally, overwhelmingly, it's all about the cash flow.
Very helpful considerations. Elan, any final words for listeners that could include how people can reach you and anything at all?
Sure. I mean, I'm reachable at Elan, ELAN at mortgageoutlet.ca. I love talking about mortgages, so I'm happy to give a second opinion, which actually there's a couple important medical analogies, believe it or not, that I use with all my clients. So the first analogy is, getting a mortgage is like going through a medical procedure. Now, there's two things there. If I came to you and I said, hey, I want you to do a quadruple bypass because I went to WebMD, start it right now, there's no physician in the world that's going to say, cool, let's get the operating table out. A good physician will do an MRI, a CAT scan, an EKG, blood pressure, and all of the tests. Because you don't want to be on the operating table and find out that the client is allergic to penicillin. So my first analogy is all documents up front. I do not give advice until I know I co-signed my sister's car lease and I have student loans in the United States and all of that stuff. So that's one of my medical analogies. The other one, which I just mentioned, is a second opinion. So I always encourage my physicians, go talk to your bank, right? But then come to me and I will say, you know what? They're giving you a really good deal. They know you, blah, 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 blah. Stay with them. And now you've gotten a second opinion to, ground your decision, as opposed to, your bank is advising you this. And I'll be like, wait a minute, I can get you a variable rate mortgage. I can get you a HELOC. I can get you a holdco. And they don't offer that service. So they're not. So again, second opinion. It's there's no fees for it, but that's something I would definitely recommend. And again, another few things, like real estate is a long-term play. I'm extremely bullish on the Toronto real estate market and the Canadian real estate market in the long run. If you have the financial strength to weather some uncertainty, some storms, I do think that, there's a lot of opportunity in the long run, and I'm bullish overall.
I agree with you. That's why I've kind of pursued this path as well. One thing I can say, Elan, is I have come to you for second opinions. I will email you, we will chat, and there have been times when you have been, you're always candid, first of all, but where you have just said, listen, you're getting a great rate, and you could go to any lender. It's going to be very hard to beat that. And then there you go. I've gotten my second opinion. So Elan, as always, thank you for making the time. One of the reasons I like to have you on the pod is that you're a good teacher, you're clearly passionate, and you're very knowledgeable in what you do. So good luck to you and the whole Mortgage Outlet team, and keep up the great work.
Okay, well, pleasure to be here.
Thank you again for joining me on Beyond MD. If you're enjoying the podcast, please consider sharing this podcast with just one person in your network. I would be truly, truly grateful. Lots of episodes in the pipeline. There will be some physician conversations, a solo episode. I will be talking to people about GICs, alternatives, and in the new year, some really interesting real estate episodes. One will be featuring Graybrook, and the other will be a multi-podcast series with Quentin D'Souza focused on multi-family investing. So I'm really excited to be learning about all these topics and bringing them to you. My website is almost ready, just a few final touches. In the meantime, you can reach out to me at beyondmdpodcast@gmail.com. You can connect with me or follow me on LinkedIn. And as always, stay well and stay savvy.